A ticking time bomb is ready to explode in the U.S. housing market as lending is plummeting, foreclosures are soaring, and home sales prices are in free fall. The recent bank collapses and skyrocketing interest rates have created a housing crisis in the U.S. that is much worse than anticipated. Even renowned investor Michael Burry is sounding the alarm, warning of a potential overnight drop of up to 20% in property values. As a homeowner, you simply cannot afford to turn a blind eye to this severe situation. Buckle up and stay tuned because understanding what's happening in the market is crucial to prevent your dream home from turning into your worst nightmare. During the pandemic, the U.S. government and banks took a unique step by lowering interest rates to almost zero to jumpstart the economy when everything was shut down. This move made more people want to buy houses as investments and turn the housing market on its head. For instance, between February 2020 and September 2021, home values increased by over 15% in many places, and existing home sales and building permits for new housing hit levels not seen since 2007. With lower interest rates, banks were more likely to lend money to investors and housing market developers, resulting in a significant increase in loans granted to the housing market. In fact, according to the U.S. Federal Reserve, as of January 2021, mortgage debt outstanding in the U.S. totaled a staggering $10.5 trillion, an increase of $500 billion from the previous year alone. The low interest rate environment of the pandemic not only drove a significant surge in loans granted to the housing market, but it also caused the U.S. economy to overheat and ignited a dangerous flame of inflation. To solve this issue, the Fed had to step in and raise rates from near zero to an astounding 5 percentage points in just 12 months. The fastest rate increase in 2 decades and the highest since 2007. However, the recent spike in interest rates has caused a domino effect that is shaking up the U.S. markets, and the U.S. housing industry is taking the brunt of it. Depositors have lost confidence in banks and are withdrawing their money at an alarming rate, leading to a full-blown crisis in the banking industry. Despite this, the Federal Reserve has made the decision not to lower interest rates, and as a result, banks are becoming extremely cautious about who they lend money to. Numbers are shocking. The Federal Reserve recently reported that bank lending dropped by a staggering $100 billion in just 2 weeks at the end of March, marking the most significant decline in lending in half a century. Particularly, real estate loans have taken a massive hit, with a $37.8 billion plunge in the second half of March alone. This marks the most significant plunge since the devastating 2007 financial crisis. With increasing interest rates, homebuyers' monthly mortgage payments are now up 29% from last year, which was already 39% higher than the prior year. This means that potential buyers are paying 50 to 60% more for a home today than they would have just 2 years ago, all because of the interest rates surpassing the 3% threshold. It's a harsh reality, and it's taking a toll on homebuyers' ability to finance their dream home. In fact, mortgage demand has fallen to a 28-year low. For instance, just between March 2021 and March 2023, the number of new mortgages being approved dropped by a stunning 83%. It's a tough time to be a borrower, and the implications of these events are far-reaching and complex. With interest rates surging up to around 7%, it's becoming increasingly challenging for investors who bought buildings with floating interest rates to keep up with their loan payments or even refinance their loans. As a result, some may be forced to sell their properties, while others may default on their mortgage loans, further exacerbating the growing number of Americans losing their dream homes due to foreclosures. In the first quarter of 2023 alone, real estate data provider Adam reported almost 96,000 homes being repossessed, a staggering 22% increase from the previous year. States like Illinois, Delaware, and New Jersey are being hit particularly hard with foreclosure rates skyrocketing. For example, in Illinois, 1 in every 762 homes was foreclosed in 2022. Meanwhile, in California, nearly 7,000 foreclosure proceedings were underway in the first quarter of 2023. Overall, the combination of excess housing supply and pandemic boomtowns, tighter lending conditions, and foreclosures is impacting property values, making it a challenging time for both buyers and sellers. According to Redfin's latest data, in March, the median U.S. home sales price fell 3.3% to $400,528, representing the largest year-over-year decline since 2012. This comes on the heel of a 1.2% dip in February. which marked the first annual decrease in prices in nearly a decade. Pandemic boomtowns and pricey Bay Area markets are leading the decline in U.S. home prices. For instance, in March, Boise, Idaho felt the biggest hit with prices falling a whopping 15.4% from the previous year. Also, Austin, Texas saw a drop of 13.7%. Sacramento, California experienced a decrease of 11.9%. San Jose, California felt a 10.5% fall, and Oakland, California saw a 9.7% drop in home prices. And it's not just specific cities feeling the pinch. Pending home sales have decreased by 26.6% nationwide on a seasonally adjusted basis, hitting their lowest point since the start of the pandemic in April 2020. The reduction in pending home sales is one of the critical drivers causing home prices to drop. With fewer buyers in the market, sellers must lower their asking prices to attract the limited pool of potential buyers. It's like a domino effect. One thing leads to another, and it's affecting the value of homes all around the U.S. The first quarter of 2023 was ruthless for the U.S. housing and real estate markets. Sales of apartment buildings took a nosedive, dropping a staggering 74% compared to the previous year, the biggest decrease since the 2009 subprime mortgage crisis. But it's not just apartments feeling the heat. The whole residential housing market is in turmoil. According to Standard & Poor's market intelligence data, home prices have been on a downward trend for 9 months straight, with no signs of improvement in sight. Even experts are ringing the alarm bells, warning that as many as 20% of U.S. homes could be vulnerable to a correction similar to the one that rocked the country in 2008. To make matters worse, for the first time in history, banks are now losing money on every mortgage they finance. The combination of declining housing demand, falling home prices, and rising financing costs have caused banks to lose an average of $301 per mortgage financed, which is a massive 113% drop from the previous year's average income per mortgage, according to the Mortgage Bankers Association. This situation is causing some lenders to go out of business due to the sudden spike in lending rates, and it's the worst crisis the industry has faced since the housing bubble burst 15 years ago. For instance, Sprout Mortgage and First Guarantee Mortgage Corp have already scaled down or ceased operations altogether because they specialize in riskier lending that doesn't qualify for government backing. First Guarantee even filed for bankruptcy because the loans it made earlier this year dropped in value. It's a challenging time for lenders, and this negative profit for financing home loans is a concerning development that's shaking the foundations of the American real estate and housing industries. Now, with the housing market downturn and foreclosure rates on the rise, some banks are stepping up with a supposed solution: the 40-year mortgage. It's a new take on the classic mortgage with lower monthly payments and an extended repayment period, making it a tempting choice for those looking to ease their loan payments. However, a 40-year mortgage comes with certain risks that need to be carefully considered before deciding on it. For instance, the interest rates on a 40-year mortgage may be higher than those on shorter-term loans. And even if they're the same, a 40-year mortgage will still be much more expensive in the long run. To give you an example, if you borrow $400,000 at a fixed 4% interest rate, your monthly payment will be $1,910 with a 30-year mortgage, but only $1,672 with a 40-year mortgage. But don't be blinded by the lower monthly payment. You'll end up paying an extra $114,962 in interest over the loan's life. Another downside of the 40-year mortgage is that since you'll be paying less principal and more interest over time, your equity will grow slower, making it challenging to refinance or obtain other loans that require a certain amount of equity. At the moment, 40-year mortgage loans are only available to those in mortgage default or forbearance and struggling to make their house payments, but it might become an option available to everyone in the near future. In any case, make sure to weigh your options carefully before signing on the dotted line. The housing market in the U.S. is teetering on the edge of a catastrophic collapse. Lending has plummeted to an all-time low, foreclosures are skyrocketing, and home prices are plummeting at an alarming rate. With no sign of housing prices stabilizing in the near future and borrowing costs soaring, it's definitely not the time to make a rash decision about buying a home. Although the idea of a 40-year mortgage may seem enticing with its lower monthly payments, you must carefully consider its significant pitfalls in order to avoid falling into the bank's insidious trap. In the end, it's better to be safe than sorry, and waiting for a stable housing market may be a wiser choice.